is Mike Langford. Welcome to another episode of the Modern Financial Advisor Podcast. This week on the show, I have Larry Nisenson from Assured Allies with me for a conversation about a concept that's been top of mind for me for many years now. It's the need for long-term care insurance. More specifically, the need for financial advisors to be discussing the need for some sort of long-term care insurance with their clients. Why? Well, as you'll hear Larry share, the probability that your clients will need some sort of long-term care is extremely high, and the cost of securing long-term care is also high. So if you created a 4x4 diagram of risk probability and cost, you'd find that long-term care is in the upper right square, high risk probability and high cost. Now, I promise this is not going to be a doom and gloom episode. As with all episodes of the Modern Financial Advisor Podcast, my goal is to shine a light on opportunities for you and your firm to grow your business and serve your clients better. Talking about long-term care insurance is squarely in that category. Now, before we get rolling, make sure you subscribe to the podcast on Apple Podcasts, Spotify, Google Play, Amazon, the YouTubes, or wherever you like to get your podcast jam on. And if you have a question or a suggestion for a guest or a topic for the show, hit me up. I'm basically at Mike Langford everywhere on the internet, or you can shoot me an email, podcast@finservmarketing.com. Okay, let's get to the conversation with Larry Nisenson. Well, Larry Nisenson, so wonderful to see you. I am glad you're feeling better this week. Welcome to the Modern Financial Advisor Podcast.
Mike, thanks for having me. I'm super excited and, might I add, healthy. So really happy to be here and feeling 100% better.
Yeah, it's always, you're not the first person that's ever happened to. By the way, I'm probably the person who has had to ping somebody and say, listen, we need to table today's recording. I woke up and feel like absolute junk or what have you. So I really appreciate you letting me know, because nobody wants a dude who's hacking or looking green on you just take a break. We'll come back when you feel your best.
I am naturally enthusiastic. So I could only imagine how terrible I would have been, like under the weather. I'd have been like, yeah, Mike, this is really great stuff we're going to do today. Like, that doesn't sound very inspiring, right? Like, so yeah, let's get us at our optimum.
Yeah, exactly. Let's do it. So we're going to dive right into this conversation, because this is something, it's kind of near and dear to my heart. I have elderly in-laws. I have, older parents and so forth. And we're going to be diving into some long-term care conversation. So I have a feeling this conversation, this episode is going to be somewhat transformative for some of the financial advisors listening or watching. And I don't say that often to like overhype things. I'm not overhyping every episode, even though it sounds like I do. Because I think what we're going to be talking about today might actually change the way some advisors render financial advice in an extremely positive way. So let's set the stage. What is the probability that the clients of today's financial advisors will need long-term care at some point in their lives?
Well, so I'm going to throw some numbers out. We're going to talk through the market, but I want to give the full disclaimer, which is this. I was a financial advisor earlier in my career. I know the difficulty around providing holistic financial advice and getting clients to actually listen, right? The ability to get them to listen at the right time for the right reason and take action, super, super hard. It's even harder when it's something like long-term care insurance for lots of reasons, right? The first reason is that there's headline risk. There's lots of headlines, not many of them good, about the old version of long-term care insurance. It's expensive. The insurance companies got it wrong. They're taking rates. If I was a financial advisor, my question would be, why do I want to bother with something that's only going to potentially create a nightmare service for me? I'm going to have to deal with clients who are unhappy, who get rate increase letters, all of the things. I get it. But here are some statistics that really are shocking. There's no other way to really say it, right? So we know that the number of people over the age of 65 by 2030 is going to be somewhere around 55 million people, right? And so let's talk about that audience. Your audience knows the baby boomers, 10,000 a day, turning 65 from now until 2030. We all know the statistic.
Yeah.
But what's crazy is that somewhere between 50 and 70% of them will require some sort of long-term care help, long-term care services. So we're talking about non-medical help, right? This is around the activities of daily living. We're talking about getting out of bed and being able to bathe and dress
Yeah.
and shower and feed themselves and do, really base things like be able to go to the toilet themselves. These are things that are not covered,
Yeah.
by the way, through Medicare. And that's a really important point. Most people who are unaware think that Medicare or private health care is going to cover this, and it's not. So between 50 and 70% of those over the age of 65 are going to need help. And here's the crazy thing. Since the beginning of time, long-term care has been around for 40 years. And over that span of 40 years, so I'm not even talking about what's in force today, I'm talking about over the entire span of the product life cycle, we've only sold about 6.5 million policies. So of those 6.5 million, there's only about 4 million or so that are still active and in force. These are people who aren't on claim already or passed away. So against the backdrop of 55 plus million people, let's call it 50% are who are going to need it. So let's get that number to 27 million. Only about 4 or 4.5, let's stretch it to 5 million, have planned for this type of coverage, right? So the vast majority have not and are generally unaware that this is even a thing they have to worry about.
I'm glad you took us through it that way and didn't just blurt out the number. So I guess I was hacky in my way I asked the question, but what really stuns me, and I like I said, where I think this conversation can be transformative for financial advisors in the way they render advice to their clients is if you think about probabilities of things happening for your clients in the future, if we're planning for something, if you know that there's a 50% chance, and it's not like, oh, well, it either will or it won't, but we know that there is a 50% likelihood. So if you're managing a client that is a couple, one of them is going to have some form of long-term care need, almost certainly. And then you look across your entire client roster, the things that you're planning for, if you're not including this, including some form of like what happens if, and whether that be through an insurance product or whether that be through more aggressive savings or downsizing or whatever, or we're going to talk about a whole bunch of different solutions here today. But to me, it's like, you think about anything. If I told you today there's a 50% chance that you walk outside and a jet engine is going to fall and kill you as you walk outside, you'd be like, what, 50%? I'm not going outside anymore, right?
How do I get to the how do I get to the tunnel, right? I'm not going outside. I'm going to tunnel.
Exactly. I'm not going outside anymore. So I know it sounds dramatic, but it's like, that's a big deal, right? Like this is, and to your point, it's not like that, 50% of people are going to be in an assisted living facility. We know that's not true, but like, we know that they're going to need something, and it could be like recovering from an operation. Like you said, it could just be like as they get older, like they need help getting dressed, or they can't drive themselves anymore. That's a form of
Mike,
assisted living, getting to the store,
It's even more daunting than that. Like, let me just give you maybe a few other just relevant facts, right? So nationally, the average long-term care event, so somebody that needs a long-term care help, the average event is about 2.5 years. And on average, it costs about $250,000. Okay. So as an advisor, I want you to think through a simple question. If you had a client that called you tomorrow, and I'm sure your audience can think of many clients who have called them in the past, how disruptive is it to a financial plan when a client calls and says, oh, by the way, I need an unexpected $10,000 a month to be liquidated and put into my bank account to cover my long-term care needs? How disruptive is it to an advisor who's set upon a plan? Either, we think about financial advice in three general buckets, right? The accumulation stage, the pre-retirement stage, the income producing stage. How are we helping people live in retirement?
Mhm.
And that is really where it's super disruptive. So somebody's not working anymore. You've got them on an income plan. They need
Yeah.
X, and all of a sudden they get this. You get a call that says, "Oh my gosh, my husband just fell. He's going into a facility, or bringing somebody in. I need $10,000 a month." Or we
Yeah.
get somebody who's fortunate enough, they've worked with an advisor who's done a great job through the first two. And now, right now, they have assets to actually transfer to the next generation or to their favorite charity, whatever their goal is on the generational movement of money. Their advisor has likely played a key role in all three stages. But if they have not at least had the conversation around what is going to happen if you have a long-term care event, it's likely when they get that call,
Mm.
right, the advisor is going to have to scramble to either liquidate assets, reposition assets, have conversations around what the change in lifestyle is going to mean to their client, right? They've had a dream, they wanted to retire, they were going to travel around the
Yeah.
country in their Airstream, and now they have to learn that they don't have the money they thought that they were going to have. What we say to advisors, what I've spent the better part of 30 years talking to advisors about, is just having the conversation. For clients who want to self insure, and there's lots of them, right? If they choose to self insure, meaning they're going to either, to your point earlier, aggressively run at accumulation and say, this is going to be my money, and if I need it, I need it, or they're going to bury their head in the sand and pretend it doesn't happen. The role of a financial advisor, right, is to contemplate those things that may or may not occur, and when it's likely to have a 50% to 70% chance of occurring, how, as an advisor, don't you have that conversation? You've got to at least bring it up. You've got to have something in the file that says, I spoke with my client about this and this is what they decided. That's sort of the position that we've
Yeah.
taken, and it really is, it's daunting to think about, but it is crucial. It's a crucial part of somebody's preservation of wealth.
Yeah. During our prep call, you mentioned that it's very common for the holistic financial planning process to miss this long-term care thing. And I think you actually mentioned it a little earlier in this conversation. So I guess the first thing that pops into my mind, I guess, is do you have any data that illustrates like the extent to which long-term care is being underplanned for or not addressed at all? I mean, has there been any surveys of like financial advisors, do you talk to your clients about this problem? And I guess now we're relying on whether they answer it honestly or not. But like, is there anything? Has there been any study on that and how often
There,
it's missed?
yeah, there have been some studies, and you're 100% right in saying they're self-reported. It's like asking, this is a terrible
Sure.
analogy, but like it's asking somebody to come that comes out of an exam, can you tell us if you cheated? Right? Nobody's going to self-report themselves. You have to be really like it,
Yeah,
it
yeah,
would be amazing if you did, but to me, the proof in some ways is in the pudding. It's in the results. We know how many
yeah,
financial planners are meeting with clients. We know the trillions of dollars in retirement monies that are moving from generation to generation, almost all of which these days is being done through financial advice, holistic financial planning, right?
yeah,
And we also know, and I'm going to give you an example and some statistics again around this, that the vast majority, well over 90% of clients, are not purchasing long term care related protections. And I say it that way because
interesting.
there's many ways to drive at coverage, and there's standalone long-term care, which is what we've seen for 40 years, and there's life long-term care annuity long-term care hybrid products, and there's
Yeah,
some people using mutual fund complexes in order to try and solve this. There's lots of ways, and maybe even some advisors that are doing what you had suggested earlier, which I kind of tipped my hat on, which is saying to take a segregated source of funds and say, we're going to use this pool to drive
yeah,
hard at this. So it's not a pure number, but here's what we know, that last year, so in the height of long-term care sales, which was like 2003, okay, 2002, 2003 was the height of individual long-term care sales. the industry itself sold about $2 billion of new recurring premium, right? These are new
Mm-hmm.
policyholders who stepped in and wrote a check for coverage. And since 2003, we've been on a deep and steady decline. And in
Interesting.
2023, the industry sold in that same category, again, 2 billion. The industry sold about $160 million of the same measurable insurance at a time when we already covered the number of people aging into these products, right? These 10,000 a day has never been greater. So
Mm.
here
Yeah.
it's unnatural to have a greater demand in theory of people who are aging into it,
Yeah.
yet less people purchasing it. So we know that advisors are generally shying away, but it's hard to get them to self-identify to what degree they are.
Yeah. Well, and maybe you have a different take on it, but I suspect the reason why advisors don't is the same reason why many advisors don't advise on investing in small businesses or investing in real estate, right? So their license and their revenue stream, their business model is not based on So you think about the independent broker dealer model or the RIA. It's like, well, one has a Series 7 license that can sell and earn a commission or a fee from selling stocks, bonds, and mutual funds. On the other side, one has a license that allows them to charge a fee for rendering advice on marketable securities. So their fee structure very often is tied to that. And we aren't that far removed from people calling them stockbrokers. I say it all the time on the show, right? Like they used to refer to themselves as stockbrokers not too long ago. And then suddenly we started talking about holistic advice and so forth, as you mentioned, and more. And this has actually been an interesting trend, trying to get financial advisors to offer financial planning and not just offer effectively asset management, because financial plan is a fee that people will actually pay for because they need greater and more holistic financial advice. So I suspect that's a big part of it. Um, but yeah, like getting it into the business model, and it sounds so awful to say it that way. Like, hey, listen, you'll care about it if you find a way to make money from it. If you find a way that this works with your business, right?
Yeah, there's actually a couple. It's really fascinating, right? I'll add one maybe anecdotal piece of it. There's not a salesperson in the world who wants to sell something that he's not an expert on. So it's really easy to
Sure.
default back to what you know, right? What is tried and true?
Mm-hmm.
What could I wake you up at 3 a.m. in the middle of the night and ask you to be a subject matter expert on, right? And we're always going to
Mm-hmm.
default back to that because we feel confident, we have the answers, we have our spiel, we know how clients are generally going to react to it. And long-term care insurance is not that, right? Long-term care insurance is that for
Mm-hmm.
long-term care licensed specialists, and there's lots of them. And many of them, by the way, work in partnership with holistic financial planners for exactly that reason. The planner says, I'm going to take care of
Yeah.
the money aspect, and you're going to take care of the risk aspect, and we're going to come together and meet in the middle. But there's this other idea that I think is still, I say this with a smile on my face because I'm going to say I think it's still a thing because it is a thing, right? The panacea
Yeah.
of holistic financial planning is this idea of intergenerational wealth transfer. I have a client who I've
Mm-hmm.
worked with forever. I've helped them through all three of those stages. I really want to be able to provide that same level of guidance to the next generation, to their children, to whomever it is, right? I want to
Yeah.
create a living legacy for the family that I'm working with. And there is no greater in my mind. Again, maybe I'm biased because of what I do, but to me, there's no
Yeah.
greater way to pull that family in than to talk about family caregiving because you and I, and we've talked about this before, that For those that have not planned for long-term care, they rely initially and almost exclusively on family caregivers. That's sons, daughters, nieces, nephews, spouses to provide that care because they don't have coverage. And so imagine if the conversation a financial advisor said to a client is, I want to talk to you about family caregiving, and I want to bring your children into the conversation so we know how you as a family want to prepare in the event you need long term care services. Now, what a great conversation it is because I'm not throwing a solution in. I'm merely offering a fourth group of services that I provide, which is the inevitable, the likely planning for long term care. And now I've begun a relationship with a family that, regardless how it's solved, I'm meeting the family. I'm showing a level of care, a level of maturity, a level of professionalism and giving me that door opening opportunity to meet the next generation. And I'm not sure why more advisors aren't using that as an opportunity to begin that
Yeah.
conversation, but it seems natural to me.
It's, boy, that really feeds into a couple of things. So I can attest, having gone through it and recently in family where, family members had to go into assisted living. Um, it can come as quite the surprise, and the frantic scurrying around to figure out how this is all going to work is challenging for even the most hardened person, right? It's really difficult to all of a sudden like, oh geez, mom and dad need help, need to go in a home. They can no longer live by themselves anymore. And it might have started, gradually where you're swinging by and helping mom go shopping and help, doing a couple other things, maybe clean up around the house and all that type of stuff, taking them to their doctor's appointments. But all of a sudden you recognize this is beyond me. So you've kind of wish you had that conversation before. You kind of wish you talked to somebody like, okay, what might this glide path look like? And when is the inflection point where we should recognize and we agree? It's kind of like, I always think to myself, like, shouldn't there be a conversation that you have with a parent who's aging? Hey, at some point in time, I'm going to tell you it's time for you to not drive anymore. And I want that time to not be when you've gotten an accident, and crashed through a storefront somewhere. I'd rather have it like at some point in time, I'm going to notice, hey, I don't think you're safe driving anymore. And it's okay. I'm not, I don't hate you. I'm not trying to take away your freedom. I'm trying to save your life and others' lives. So that's one thing that really jumped out to me is like, these conversations are great to have early instead of when they're an emergency. And then the other, oh, sorry, go ahead.
No, I was just going to say on that point, just quickly, it's, we have this mantra, caregiving takes two forms, right? One of them you have 9 months to plan for, and the other one you have 9 seconds to plan for. You get that phone call, mom fell. You get that phone call, dad fell in the shower. You're in reaction mode. Your life you didn't have on the other side where you planned, you built the nursery, you figured it out, who was going to stay home, what was the baby. You had plenty of time on the child side. You have zero time if you haven't begun the conversation and planned it out. And I will tell you, just if my parents are listening, they'll probably either chuckle at this story or I'll hear it from it at Sunday dinner, that I'm in this business a long time and I talk about exactly the things I'm talking about today every day and build products and services to take care of this every day. I sold my parents long-term care insurance back in the day when I was a retail advisor. And when I got that call, I was as woefully unprepared because in that moment, I'm not the professional. I'm the son, right? I go all the way back to being the son, and you want to take the best care, make the best decisions. And we were prepped, and I still second guessed myself. I could only imagine for those that haven't done anything, what that must be like. I mean, it must be just nerve wracking, fraught with peril around, do I make the right, and what role did that financial advisor play in helping to prep a family? That's really the stuff we think about.
Yeah. It's funny, and that just ties right into what I was, the other thing that I'm thinking about as it relates to the children, almost every financial advisory firm out there is trying to think of ways to connect with the heirs, right? Because we've heard it. You talked about, the baby boomers, 10,000 of a day. Everybody's talking about this great wealth transfer that's coming and so forth. And one of the things that keeps advisors awake at night is the concept of potentially waking up the next morning and finding that there's a couple $1 million missing because Larry has just taken over his parents' account, and Larry doesn't have a relationship with the financial advisor. So Larry just calls his financial advisor and says, "Hey, listen, I got to take over my parents' stuff here. Um, let's get their money moved over real quick. So send over the TOA. I'll take care of everything for them." That happens. Almost every financial advisor who has older clients or at some point in time has realized like money has gone out the door, unbeknownst to them. But having the conversation you're talking about reaching out and talking to the children about, hey, we're starting to talk about, long-term care for your mom and dad. Here's some of the options that are happening. Here's how they're handling it. But we need to make sure that you're prepared a little bit too, because, well, chances are when things start happening, you and I are going to work a lot together, right? You're going to need to tap some of these assets. You're going to need some of the financial resources to know where things are. So I need at a minimum, you've got my number and my email. You've met me at a minimum, right? And then potentially we might start working together now to have certain things in order just to make sure. Like, so as an example, what happens if you have to sell the house in a hurry? If you feel like you need to do that, what happens if you need to empty the home? We've actually we've got a list of services that we've used with other clients for doing those types of things. What a wonderful, and I know it can sound morbid because you're like, I have this, but it actually is. You want to talk about the epitome of fiduciary advice, of caring for the client and putting their needs first. That is a great example.
There's no question, Mike. By the way, the whole ACAT process, right, of the beneficiaries moving that money, by the time an advisor, and every advisor who's listening knows the pain of this, by the time you find out,
yeah,
it's too late. It's gone, or it's in process, right? And
yeah,
the number of times that
yeah,
that a client's children say, "I don't even know who you are. Now all of a sudden you're calling me." This is such a great
yeah,
opportunity to do right by the parent, right, your client,
yeah,
do right by the child or the beneficiary, but more importantly, imagine, just take your example. It's a great example. Imagine if you said to the family, right, we're going to have a family meeting, and you say to those beneficiaries, the way we've constructed this account, when your father, your mother need care, this is the assets that we've either tucked to the side or purchased that are going to be able to create the income stream to support them in whatever environment they want. Most people want to start by aging in place at home, of course. Nobody wakes up and says,
yeah.
I can't wait to go to a nursing home or assisted living. They all want to age at home. And
Right.
imagine if the advisor said, here's what we've done. We've helped to create a budget. We've allocated these assets. We can have them living at home without repositioning assets for X amount of time. We've done that work, and we've constructed the portfolio in a way that ultimately, when your parents pass away, we've got it positioned in a way that's really going to help leverage this for your intended use. What
Yeah.
beneficiary, what child wouldn't say, wow, even if they ultimately moved it because they have another advisor, you've at least given them something else to think about, and maybe, right,
Yeah.
maybe helped retain those assets before it's too late. So wholeheartedly agree. And there's just one other component that I would put my compliance hat on for just a second. I'm not a
Okay.
lawyer, but I'm married to a lawyer, and my wife, if she were here, would give me a pat on the back for mentioning this also. That ultimately,
Okay. I
we
love it.
haven't seen this yet. I want to be really, really clear. We have not seen this, but I think it's only a matter of time until we start seeing litigation, right, from people who are beneficiaries of accounts, whose parents, their loved ones, had gone through a long-term care scenario and have had their retirement savings depleted, from somebody who had their hands, air quotes, was a holistic financial planner, didn't position long-term care insurance with their parents, And a beneficiary says, I don't understand. My parents told me they had $2 million. What do you mean there's only $1 million here? What do you mean there's only $1.3 million? Where's the rest of it? And they say, well, they had a long-term care event. And the beneficiary says, well, you didn't, what did you do to protect him? What did you do to talk to him about it? If that financial
Yeah.
advisor doesn't have in the file something that says, we talked about long-term care insurance, I positioned some ideas. Ultimately, if the parent decided to not purchase it, that's not on the advisor, right? That's on the client. But it is absolutely on the back of the holistic financial planner to present
Yeah.
scenario planning, especially for something that's not, 50, 60, 70% likely to happen. I don't know how that would be
Right.
defended in litigation if they didn't have something that said, hey, we talked to them about it, but they were uninterested in it.
It's a great point, and I know and for some people they might think that's a scare tactic, but I don't. Look, we see people get sued for stuff all the time, right? And that's basically a good, it's the classic negligence, right? The reasonable person test is where
Yes.
negligence comes in, right? It's like, would a reasonable person assume that a holistic financial plan would cover all of the likely scenarios that somebody might have in their life? Now, look, finances are a resource. There's only so much to go around for most of your clients. And so you're trying to figure out, like, what is the best way to use these resources while you're young and vibrant, when you're retired and consuming assets and having fun as well. And then there are some, like in your end years, where you may need other, assisted living or some other long-term care. So those are, to your point, they're likely scenarios. You can't just tell me you ran Monte Carlo simulation and like, yep, this portfolio looks like it's going to rock and roll all the way through. It's like, no, like, what are the things that might happen? Like, as an example, like, the next topic I wanted to tee up here is like, most financial plans include some conversation about, where the clients are going to live in their twilight years, right? So we talk about, okay, there's a lot of variabilities that come into play, like downsizing to free up equity in the home, maybe, or just to live in a smaller space. You might move to a no income tax state, such as Florida or my state here in Texas. And there's a whole bunch of other variables there that you will talk about and how it affects your plan. There's the stages that people often talk about in financial planning. Like, when somebody retires, they generally spend a ton in those first few years, right? Because the first third years, because they're traveling like
Yes.
crazy, they're whooping it up. They suddenly have all this free time. They're going out to eat all the time, right?
Doing
They're doing
everything they ever
just
wanted to
everything is
do.
rocking. They're buying
Yes.
that sports. Right, buying the sports car you always wanted to have. Like, look at Grandpa, he's crushing it with a convertible. And then, like, the second, third, they're still doing some travel and so forth, but they're not going out to eat as much and so forth. And then usually the last third, you're staying closer to home and so forth. But in one of those variables, to your point, there's a that notion is that the costs are going to step down. The real expenses are going to step down like over time. But what we're saying here is that no, there might be a big spike, right?
Yeah.
And of course, for the holistic financial planners, that might be like going, no, Mike, we have this, but yet this is the reality of life, as you're saying.
It is for sure. And by the way, one of the, we talk about this idea of aging in place, and my company
Yeah.
really is about this idea of aging in place. So aging in place is a real thing. And aging, nobody wants, as I said a few minutes earlier, nobody is looking forward to moving into a nursing home. Everybody wants to stay. And there's lots
Yeah.
of evidence, by the way, around how that staves off cognitive decline to allow people to stay in their surroundings. They see their family pictures on the wall, they're in familiar places, they're amongst their friends. So
Yeah.
there's lots of evidence around people staying in and aging in place. But that does not come for free, right? The idea of
Yeah.
helping people modify their homes, the idea of helping people do things, simple things. A large percentage of accidents for aging adults occur in the bathroom, right? So we encourage those that want to stay in their homes to modify what their bathroom looks like. Maybe it's taking out a step-in shower, right, and putting
Yeah.
in one with a door. Maybe it's putting grab bars. Maybe as they get older, it's putting in a bath transfer seat, which allows them to sit down and get into a bathtub.
Yeah.
These aren't huge expenses, but they are and for many people, they're unanticipated expenses, right? That financial advisors could
Yeah.
be easing into those conversations around long-term care needs by talking just about where is it, Mr. Client, that you want to grow old, right? That's a really sort of
Yeah.
wide-ranging question. It pulls into geography, to your point earlier about states like Texas and Florida and others. It pulls in the idea of do you plan on moving in with children or living closer to children? Are you going to move to
Yeah.
Arizona? I have an advisor of ours that lives in Arizona, and his entire practice is mostly made up of retirees that moved to Arizona away from their loved ones. So what he does, and you kind of touched on this, Mike, I almost brought it up then, but it sort of fits now, is he's assembled a whole
Yeah.
ecosystem for aging adults that don't have family nearby. So he's got like all of these services that people can
Smart.
purchase because he knows that these people are aging on their own. These are great conversations for an advisor to have that allow them to sort of dip their toe in the conversation around long-term care insurance coverage, but not having that
Yeah.
conversation per se, like dipping your toe and leading into it in a less threatening way. And these are the types of things that
Yeah.
we help train, by the way. We have websites and we have training material to help advisors start to think through how to have these conversations.
I love it. And I'm glad you brought up the modifying the home thing, because I was actually going to bring up, there's a great blog post on your site, and we'll get it linked up in the show notes. It's called "Is Your Home Ready to Age with You?" And I really started thinking about that, right? Like, yeah, if somebody's been living in the same home for like 30 years, but suddenly they're, 80 or whatever, an advisor should say, hey, I'm thinking, have you guys modified your house at all? So as I look at your plan here, we may want to, like, because I know a lot of folks, sometimes heck, you can even throw yourself under the bus. Heck, even I have a hard time occasionally getting in and out of the tub. Having those types of things, we find that that's a really smart thing to do, because advisors, look, they come to you for, you're their trusted advisor. And it's not just on like, how much money do I have? It's, I want to make sure I live my life as vibrant as possible, and finances are a tool. Well, there are things that they haven't thought of. So coming to them with specific recommendations that are relevant to their life. I love the Arizona advisor you mentioned, because I was thinking about this conversation, and I think about it with myself, right? If I move to another part of the country, I think I still want to live in a reasonably good sized metropolitan area, right? Because there's probably a lot more care facilities, right? There's a lot more
For
hospitals.
sure.
There's a lot more doctors. There's a lot more probably long-term care services that come to my home if I need to. But also, I think the older you get, the less likely you are to want to drive. And so you probably either have good public transportation, or Ubers and the Lyfts and the whatever are much more abundant, versus being way out in the country somewhere, where it might be an hour trip to the nearest hospital. You know what I'm saying?
For sure. And it's not a surprise, by the way, that people are flocking to these retirement centers, right, that are catering to people, but not
Yeah.
everybody. Lots of people aging in place that will need these modifications. Mike, you're 100% on spot on.
Yeah. 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 And I also like the notion of like the asking the questions about, like, you want to live near the kids, right? Like the older you get, the less likely you are to travel. Well, are your kids going to come see you? Are you living in a place where they want to come see you? That type of stuff. Anyway,
That's
so
a separate
let's dive
question, right?
into. Yeah, that's right. Exactly. Well, my wife and I talk about it all the time. We live here in Austin, Texas now. We're both 52. So, still lots of hopefully vibrant years to come. Our kids, the oldest is a freshman, finishing up his freshman year in college. The youngest is a freshman in high school. And so, we're a little ways out before grandchildren come. But I'm thinking to myself, like, hey, wherever we live, like, because I don't know if we'll live in Austin for the rest of our lives, but we talk about it all the time, like, wherever we do live, it's got to be someplace we think the kids would like to come hang out and go see, like whether it's near a beach or it's near theme parks or whatever. Like, I don't want to live in a place where it's like, ugh, gonna go see Grampy and Grampy again. They're like in the middle of nowhere. That place stinks, So it's like,
No,
so
don't
I
drag
want to
me
have an
back
allure,
there.
right? Like, what
Right.
grandchildren?
Yeah.
Exactly. Like, come see Grampy. Grampy's got this awesome stuff. We can go to the beach all the time. We can go to the hike in the mountains. I love that stuff. Whatever it is, I don't know, but it's definitely on my mind. Anyway, I know we're getting towards the end of our time together. Let's talk about the elephant in the room, right? Because it just is what it is. Finances, right? All advisors are here like, okay, you guys, you got me. Long-term care can be very expensive, as you mentioned. You said, $250,000 is a number you put out there. And it can be extra expensive if the client needs to live in an assisted living facility. I mean, we're talking, like you said $10,000 a month, and it could be substantially more than that if
For sure.
depending upon the type of facility. What are the financial tools available to advisors to ensure that their clients are prepared financially to handle this type of stuff?
Yeah. And look, the fortunate thing is there are lots of tools, projection tools. There are lots of studies that are out there. Let's start with the Genworth cost of care study. And for those that might not be familiar with it, you can go to genworth.com. It's the largest long-term care insurance company. They don't sell policies currently, so it's not like I'm shilling for them to go buy a policy. But
Yeah.
because they have over 1 million policies in force, they do an annual cost of care, which is really an amazing tool because you can go to it, you can put in your zip code, and it will show you the cost of care, the updated cost of care across really 3 different spectrums. If you were to bring people into your home, if you were to go into an assisted living, if you went into a nursing home, whether it's private or semi-private. So for a financial planner, it's a good starting point to say, okay, if it's going to cost my client X a month, whatever X is, let me start to look at what we are generating in terms of income, expected income, future income. Where can we pull money
Yeah.
from? It's a good start to a planning tool. But I would then suggest that whatever financial planning software tool your advisors that are listening are using, they all have the ability to model unanticipated income coming out of it. I'm not going to necessarily throw
Sure.
out which one to use, but there's plenty of them out there that allow you to say, what if I expected somebody to take out 6,000 a month, but in addition, in year 3, they needed to take out another, and you plug in that Genworth number, right? And then you
Yeah.
can play around with the way you want to help your clients cover. What I would suggest, though, and certainly, if somebody wants a copy of this, I'm happy to furnish a copy of a piece that we published around what we call the care market in a bear market. So here's the scenario. You have a client. Now, we haven't seen very many bear markets recently. Almost everything we talk about when we model portfolios, right? Even Monte Carlos are now anticipating these incredible bull runs. But imagine if it wasn't.
Yeah.
Imagine if we finally settled into a bear market. We hadn't allocated monies for a long-term care scenario. And now you have somebody who has ongoing liquidation issues, but you're liquidating a portfolio in a downslide market. Modeling that is probably more important from a liability, from a presentation, a preservation of asset conversation than any other scenario. Sure, you can show somebody a 10, an 8, a 12, a 14. It doesn't matter what you're going to show them, but show them what happens if you need to come up with 10,000 a month and your portfolio is barely breaking even. That's a really ugly picture, Mike.
Yeah.
And what we say to people is, if you can show somebody that, regardless of what they ultimately decide to do, you're covered, right? You've now done your job. We don't want to scare
Yeah.
people. We don't want to shock people, but we do want to show them the impact in different scenarios.
Right.
And every planning software out there has that ability to do.
That's really good guidance there for advisors to do it. Just like tinker around with it, and again, to your point, for your own sanity, understand like that this may happen if you haven't been doing this already, and then obviously for your client, like, hey, this does happen, right? Because this is the tough part for an advisor, right? Obviously, especially when they're in the early stages of trying to win the client, you're trying to talk all positive. Like, I want to win this business. I'm going to show you how I can grow your income. You can live the glory days, right? That's going to be awesome. But you also like let them know, like, hey, reality happens, right? And one of the realities that happen that, a lot of times advisors don't talk about it because many of them have not seen a prolonged bear market in their careers, right? If you get your start in the 2000s, you've seen a couple like, hey, we've had a down year or two, but for the most part, it's popped up relatively quickly. But I tell you what, I, I studied investments in grad school, and this is a second podcast in a couple of weeks that I've mentioned this professor, Dr. Zvi Bodhi at Boston University. So Zvi, I hope you're doing great. But he talked about risk in a funny way. It's like, well, in a way it's different. Like people always talk about risk as like, what's the likelihood that we have, ups and downs or whatever. He's like, there's a couple other people, like there's the timing, that's a problem, and the severity of the risk, right? And so like if you're thinking like, well, the average risk in this portfolio and this financial model is, you're going there's less than a 5% chance that you don't outlive your money the way we programmed this. Yeah. But what if, right when they need it, the market is bad and it's bad for several years?
Yeah.
Because by the way, now, hopefully the asset allocation is such that it's, not all in equities, but still it's like, what happens if, because we have seen that happen. Like we have historic precedent for, having flat 10 years on equities. Like it actually has happened.
Well,
And it can happen again. Right?
for sure it has.
So,
And when we look at what's going on in the fixed income world, right? We see lots of people repositioning, moving assets around, trying to find that small arbitrage opportunity, right? And that's fine. I'm not here to be in the same way. I would never give financial advice to anybody. That's not my field of expertise. I can tell you the sheer number of advisors that I've spoken to over the years that said, I just wish I had started earlier. I just wish I had spoken to this client before, because unfortunately, by the time consumers become aware of long-term care needs, it's almost always too late. Now, I'm not plugging any products. There are some products out there that are guaranteed issue. There are some products that work a little differently, but for the most part, if somebody cannot perform the activities of daily living, then they're not going to be able to buy coverage, right? And so that means it's incumbent upon the advisor to help raise the education and the awareness level of their clients, and then help them make whatever the decisions are. And again, we have a website that helps advisors think through this. It's got use cases, it's got conversation starters, it's got our blog on there, Mike, that you referenced, that advisors can go to. We don't sell any products on there. It's just about trying to help move this conversation forward so that people are aware of what's likely or possible to happen and ways to potentially solve these heretofore unsolved for many people issues.
Yeah. Such good stuff. How early is too early to start? So you talked about like, oftentimes it's too late, right? But how early is too early to start having these types of conversations with a client? You got a 30-year-old client walks in the door as a financial, they have no money really yet, but they're looking to start working with an advisor so they can. Is that the stage? They should be. We be talking about long-term care options for and having that as part of their plan at 30 years old, or is that too early?
It seems crazy that would be like a sweet spot, but I'm going to position it slightly different. So I started earlier talking to you about family caregivers. This is the sons and daughters and loved ones of people who are older that have not yet purchased, didn't buy coverage, right? And so these family members are bearing the responsibility of a professional job and taking care of their loved ones. There's 40 million family caregivers in the United States. And of those 40 million, 25% of them are millennials. Okay. So they're not people in their late 50s like me. Some are. There are not people in their 60s and 70s. Sure, there are those too. But there are plenty of them in their 30s and 40s. And so the question for somebody in that age group is a slightly different question, but most important if you're a financial planner, which is to say, are you a family caregiver for anyone? And if so, how can we help prepare you for your own needs down the road? But more importantly, as an aside, family caregivers generally put less money away in their 401k. The average family caregiver spends about $10,000 a year out of their own pockets. They generally turn down promotions because those promotions require more work or travel or movement to
Mm-hmm.
someplace else. Many of the family caregivers, particularly women and particularly folks in the underserved populations, generally have to leave jobs at a greater rate if they're a family caregiver than otherwise. So if you're an advisor and you've got somebody in their 30s and 40s, they may be too young to purchase a long-term care insurance policy, but it's not too young to ask them about the impact of, if they're a family caregiver, what is it that we can help you
Mm.
do? Maybe it's helping them budget. Maybe it's helping them prepare for decisions down the road that they may or may not have to make. And it's starting to build credibility, right? It's starting to say to somebody there, maybe
Yeah.
there's something you can do for their family member who's the one in care, right? So that's for that group. The average long-term care insurance policy is generally sold to somebody in their upper 50s to early 60s. That's the
Okay.
sweet spot, but it's not the only sweet spot, right? There's plenty of new products out there that cater to those that are younger and those that are even older or more infirmed. There's still opportunities out there.
Okay. This is interesting question, but it came from a previous guest. So I want to ask, because I promised him I would ask you this question, because I had Jay Zygmunt from Child Free Wealth on, and his whole business, as you might imagine, is serving people who do not have children and have no intention on having children. And there's a variety of reasons. When that episode goes up, you can watch
Can't wait to hear it. Absolutely.
his explanation for this. It's a whole bunch of reasons. So, anyways, he wanted me to ask, how should advisors help child-free clients pay for their long-term care needs? Because as he pointed out, or the thing that he has often seen, is that child-free folks often have much less need for life insurance, right? They don't care. A lot of them want to die with zero. All right. So some of these hybrid insurance plans, that offer, an inflection point where it starts, long-term care insurance through they have less need for that. But have you seen anything about that, focuses on that segment of the market?
Not only have I seen it, I've done presentations on it because it's an interesting question, right? Like,
Oh, it's great.
why do I,
Yeah.
why should I worry about this? And the answer is maybe they shouldn't, but I'm going to create some scenarios that might give even
Yeah.
those who have no beneficiaries, have no children, but have all the money in the world to think through. And the first is this, and this is whether you have kids or not. There comes a point when if you need help, that there is a pride issue of who is helping. And I don't know many people that
Mhm.
would want their spouse to be responsible for taking them to the toilet. I don't know many people who would want their loved
Mhm.
ones, regardless of who they are, right, to have to help them get up, to shower, to wipe themselves, to feed themselves. And I don't know
Mhm.
many loved ones that want to remember their parents, their spouse in that way, right? We talk about in the final years of somebody's life,
Mhm.
wanting to enjoy the moments as their loved one, not as their caregiver, right? So the question is, regardless
Mhm.
of means, who do you want to provide that assistance? And if the answer is, I want to be able to bring in a
Yeah.
caregiver, I want my wife, my husband to remember our times together as a couple doing things that couples do, not having her or me having to help her to the bathroom, right? Then there's a cost associated with it.
Mhm.
And even if you have the means to do it, there's always the question of what else would you do with that money. Now, some people won't care, They say, look, I have a $500,000. I'm going to leave it to my favorite charity. And if it's a $500,000 or
Yeah.
$200,000, what does it matter? They're going to get something. And for those people, perhaps there isn't a need to make a long-term care insurance purchase. But for those that say, I worked my
Yeah.
entire life with a goal in mind of either endowing something or leaving it somewhere or making a mark in the world in a different way, why wouldn't you cover the cost of this potentially, right? And create the right amount of leverage to leave the biggest gift that you can to whatever it is that you were looking to
Mm.
endow or leave that money to. And it really is a personal choice. I often describe long-term care insurance for the wealthy because it's the same question for wealthy that might have children, right? Who say, "Fine, I'm worth millions of dollars. What do I care if I spend $400,000 or $500,000 between me and my wife taking care of us? I'm still leaving my kids a great legacy or my favorite charity," and that's true. But I think of long-term care insurance as a different asset class. And isn't the job of an advisor, isn't my
Mm.
goal as a saver, as a planner, as an individual planner, I mean not a financial planner, to try and leverage and cover as many asset classes as I can. And one of those asset classes is the protection of that which I saved my entire life for, right? And that's the answer. And it's not
Right.
an answer to fit everybody, but it's certainly for those that want to leave the biggest legacy is one way to protect that legacy.
I, I love that and fantastic insights. Thank you on that. And yeah, I throw one other little thing in there. Believe it or not, like if you are that wealthy couple who has plans on being able to leave millions to your kids or whatever, you don't want your kids basically sitting there going, "Wait a minute, we're chewing up all. I thought I was getting $1 million here. Like I'm gonna chew it up all day." You know what I mean? But seriously, like that could affect some kids' psyche if they had been thinking they were inheriting money for some whatever reason. We don't like to think of, but hey, we all do think about ourselves first and foremost above just about everything else in the world. We're thinking about our lives, how life is affecting us and so forth. And if they had been operating for like 40, 50 years of their life thinking that mom and dad was leaving them some sort of legacy financially, and suddenly that financial legacy is getting chewed up every month by tens of thousands of dollars, that can definitely affect their psyche a little bit. And again, I know we shouldn't be thinking about like, well, mom and dad goes, I get all my whatever,
Yeah.
but
No,
I
but Mike,
assure you, it does
you're
go through
spot
people's
you're
minds.
spot on. This is like a weird. It's this weird spot, and I think you're right. Nobody wants to be selfish, right? And we
Yeah,
all, but part of life is what is the way we want to be remembered, right? And nobody wants to. At least I think most
yeah,
people don't want to be remembered around their finances, right? No, most people don't want to be
yeah,
thought of as, oh my God, I loved my parents. They left me X. But by the same token, I want whatever legacy I leave to my children, my grandchildren, whomever, right, to be a recognition of my life's work. I want to leave them in the best place I
yeah,
can. I want to leave them better prepared maybe than I was. And we could, I don't want to get hokey about what that means, but certainly I want
yeah,
to leave them in the best financial place. And if I could figure out a way to spend X and protect 10X or 20X of that, to me, it's
right.
one thing if I don't have the money. That's an entire different issue. And we could have an entire separate conversation about those who don't have the means, the
Yeah,
discretionary income. That's really terrible. But for those that do, this to me is a matter of creating the right leverage to leave your legacy in
yeah.
whatever it is you want your legacy to be.
Love it. Love it. Well, this has been a fantastic conversation. I think very informative, and I hope advisors aren't like, now you've scared the crap out of me. I actually hope it's been one of those things that's stirs to action. Like I said, my hope is that this is a transformative conversation that helps people render much better, high quality advice for their clients, and their clients will appreciate it. Um, People are going to want to follow up. So,
Definitely.
best websites for them to go to right after this
So
is
the first website, well, maybe I'll give you one website. There's a contact form on that. So if you're
yeah,
interested in any of the white papers I referenced or any of the other stuff, you can put a note in there to reach out to me. That website is agents.neverstop.com, agents.neverstop.com.
Okay.
That takes you to the learning library. It's where we've got everything housed for agents that want to understand more about long-term care insurance. And again, we've got a lot of information there. It's not even a gated site. Just go to the site, explore, play around, and there's a contact me form.
Great.
And feel free to reach out to me through that. And I love to engage. I'm super passionate about what I do. I'm one of the lucky ones who gets to do what he loves for a living, which is, hard to be angry about that.
Fantastic. Well, Larry, this has been awesome. We'll make sure we get that linked up in the show notes. And thanks for coming on the show.
Mike, thanks for having me. I can't tell you how much I appreciate it. I'm looking forward to engaging with your audience. And by the way, thank you for what you're doing. And really thank you to the financial advisors who are listening and doing the really hard work of helping to educate consumers around all of the difficulty of aging successfully and retiring well. So thank you for all the work you guys are doing.
Fantastic. Thank you, sir. See you.
Awesome. Thanks, Mike.
Thank you very much for listening to and/or watching this episode of the Modern Financial Advisor podcast. It's always fantastic to have you with us. Huge thanks to Larry Nisenson for coming on the show, sharing his wisdom and insights about long-term care insurance, and long-term care costs and yada, yada. One of those necessary conversations that we all should have. Probably should have them more frequently than we do. We talk about a lot of other stuff in financial planning and financial advice. And this is one of the ones that tends to get skipped over or at least not stayed on enough. But it's a highly likely scenario for most of your clients that they will experience this, as you heard. So please do have this conversation with your clients in some form. Okay. All right. That's all I have for you today. Hope you're being nice to each other. We'll see you next time on the Modern Financial Advisor podcast. See ya.